On the consumption side, we had some new retail sales data out this morning, which showed a decline in terms of month-over-month real consumer spending. That follows a very, very big spike in spending that happened in January. So our take on this is that we had some really great weather in January throughout the US. This got people outside more. They spent more than they usually do in January. So usually Januaries are a seasonal lull in terms of spending relative to December, for instance, which is the run up to Christmas. So that weather, people getting out to auto dealerships, people getting out to department stores, which saw a huge spike in spending in January, has ended. That tailwind is no longer there. Consumers are pulling back a little bit according to the most recent February data, and we expect that really to continue over the coming months as the U.S. economy gradually slips into a recession, which is our forecast. On the inflation front, yesterday we got the February CPI data. It was a bit slower than it was in January. Again, we had a bit of a spike in terms of month-over-month inflation in January. It slowed a touch, but it's still a lot higher than it should be for February. One of the biggest drivers of inflation continues to be dwellings and shelter prices, especially rents. It'll take a while for rents to cool off. We've been seeing it in the monthly data from places like Zillow. They're showing that new leases are going down in price, but it takes a while for that to get incorporated into the overall CPI data. Other than that, also in-person services are still a bit of a problem in terms of inflation, but it will be a bumpy road, but we are expecting to see the inflation numbers continue to cool off over the course of 2023. We're hoping to see about 3% year-over-year inflation rates around the end of the year, and then something closer to the 2% Fed target at the end of 2024.